Our next speaker is Elliott Prechter, who has a fascination with technology, which has led him to attend MIT in 2002 and ultimately joined Microsoft in 2006. His interest in financial markets intensified during the 2008 crash, and he left Seattle in early 2011 to help start an algorithm hedge fund in Las Vegas. In late 2012, he joined Elliott Wave International's EWAVES department, which develops artificial intelligence techniques to automate Elliott wave analysis. Please help me welcome Elliott Prechter.
Hi, how are you? So, as he said, my name's Elliott Prechter, and I'm the lead developer on EWAVES. And if you were here yesterday, you heard Robert speak about EWAVES. He introduced it as a new paradigm in the computerization of technical analysis. There's a reason for that. We built our software to be qualitative rather than quantitative. And in this presentation, I'm going to go into a little more detail about what that means. So EWAVES is an acronym. It's kind of a mouthful. It stands for the Elliott Wave Analysis and Validation Expert System. It's not too complicated, though. Elliott Wave Analysis, you're probably all familiar with. Validation means that by creating this software, we're validating the wave principle, and we have some academic studies that we're working on towards that end. And then expert system, which is a paradigm of artificial intelligence, where you build software that automates the decision-making ability of a human expert. So I want to talk about the history of EWAVES. So if you will, with me, let's go back in time. This is the Treasury bill yield curve. And of course, back in the 1980s, if you remember, we were getting yields of around 18%. There were back-to-back recessions. It was a very kind of dark time economically, and many forecasters were saying, okay, we're about to get a repeat of the Great Depression. There was doom and gloom all over the world. But at this time, the Elliott wave theorists came out and said exactly the opposite. So this was an extremely bullish call. And for those of you who are not as familiar with Elliott, if you look at the chart on the left-hand side, the origin of that chart is the 1932 low right after the Great Depression. Then the odd-numbered waves, Roman numerals 1, Roman numeral 3, and the expected Roman numeral 5 there, are all motive waves. They go with the trend. And then Roman numeral 2 and Roman numeral 4 are the even number waves. Those are corrective and they go against the trend. So this model here is saying, okay, we have 5 waves that are in progress right here. We just finished up wave 4. We're expecting a huge blast off into wave 5 that should be comparable to the move that took us, out of World War II and into the space race. So this is going to be a very major move. And because it's a fractal, these patterns of 5 waves with in the direction of the trend and then 3 waves against the trend repeat at all degrees of scale. So on the right-hand side here, you can see a zoom in of that call. And for you Elliott wavers out there, 1, 2, 1, 2 is a very, very bullish call. It's saying we're going to get a 3rd wave within another 3rd wave. This is an idealized version of the Elliott wave pattern that I just showed you. So the blue line here shows that time in the early 1980s. That would be wave 4 of the move since 1932. So again, we're expecting a very large move to the upside. Now, during this time period, Elliott wave analysis became very, very popular. In the mid-80s, it was kind of a heyday. There were multiple reasons for this. One, of course, is the Elliott wave theorists popularizing Elliott waves. The fact that the call was very radical at the time. In the midst of doom and gloom, we were calling for a repeat of the roaring 20s, essentially. And another reason is just that during the 70s, the market was going sideways. So technical analysis tends to do very well during periods where people want advice and they're interested in major turns in the market. I'm sure all of you might be a little frustrated when the market simply goes one direction and doesn't really do much in the way of anything interesting. Because then people are more interested in, say, just holding an index fund and not getting a lot of advice. So, again, it was very popular during this time. And this is a picture of the Saturn V rocket at Lockheed Space Center. And 2 Lockheed engineers that worked there were reading the Elliott wave theorist. And they got very interested in it. And they were trained in AI techniques and statistics. And so they sent a proposal to Elliott Wave International saying, why don't we work on some software and build something that can automate the wave analysis that you've been doing by hand. So that's what happened. And this is quite a long time ago. The first version was put together in 1986. This is a Cray XMP. This was the most powerful supercomputer back in 1986. But there's a very good chance that the cell phone in your pocket is much more powerful than this computer, except probably for my cell phone because it's a pretty old model. But the first generation iPad was more powerful than this computer. And this is a multi-million-dollar supercomputer. So you can imagine that PCs of the time were very, very weak compared to what we have today. In fact, AI is something you've probably only heard about in movies until very, very recently, when suddenly it's starting to appear all over the media. Why is that? Well, the main reason AI is starting to catch on now is not so much the underlying, algorithms. Those actually are pretty old. We've known a lot about those since, definitely since the 80s. It's mainly just computing power has really exploded since then. Just to give you an idea of what I'm talking about in terms of speed here, the original 1986 version of EWAVES, even when we run it on modern computers, some of the tests that we do with it took initially about a month to run. So you can imagine what it was like trying to do some serious Elliott Wave R&D back in the 80s. So as a result of that, the project basically was shelved at the time, and it kind of was reborn later on when I joined Elliott Wave International. But I want to tell you my story because I had a kind of very similar story to the original engineers in terms of how I got interested in Elliott Wave analysis. Because believe it or not, I didn't know anything about finance growing up. I wasn't really that interested. I had a friend of mine actually who was very interested, and in school he would always ask me about, what's the S&P doing, and I think we're in this triangle pattern, and I was like, I don't know what you're talking about, but okay. It wasn't until I got my first job, and then I got this thing called a 401k, and I was like, well, what is this, and what do I do with it? And I realized, I got to figure something out about finance. So I was living in Seattle at the time, so I actually paid someone to give me some financial advice and explain how all this stuff worked. And I won't tell you the company or who it was, but this was late 2007. And she said, I really think what you should do is take all your money and put it in these unrated municipal bonds that were backed by real estate. She said, don't worry that they're not rated, because you get a higher yield when they're not rated. And of course, they can always sell the underlying real estate if they go bad, so you're fine. This is definitely a great idea. And I remember looking at the math and thinking, geez, if with this kind of yield, it won't be long before I won't have to work anymore. This looks great. So I called my dad up, and I was like, what do you think about this? And he was like, no, just focus on working, put your money in T-bills. Unless the U.S. government defaults, you might want to have some in some other currencies on different major countries. So, he's very, very conservative, and he said, just focus on work. So, but of course, that wasn't enough for me either. I said, no, I need to know more. Why? Why do I need to do this? And why are all my friends putting all their money in equities? And why should I be so conservative? So that's when I finally started. I read a lot of books, a lot of dog-eared books on Elliott Waves, as well as finance in general. And I started reading the financial forecast. So Elliott Waves lead analyst Steve Hochberg, I think, published this chart in 2007. And what this is showing are two different interpretations of a move from 2002 to 2007. And it so happens that each of these individually are the most common Elliott wave patterns that exist, the impulse wave on the bottom and the zigzag on the top. And both of these count very well as complete. So what this is saying is, regardless of the larger picture, this particular move has a very high chance of being done because, again, we covered two different bases here. So that is what happened, and the market started moving down in 5 waves and then rallied in a second wave. And as you can tell, it's a very nice Elliott wave. We've got nice subdivisions within it. And at this time, I remember I was just over the moon because these were things I had seen, lots and lots of examples of and pictures, and here was a live one unfolding right before me, and it was incredibly clear. And this is where the differences between me and a lot of people I talked to became very apparent in terms of their thinking. Specifically, I remember telling a friend of mine, I said, I'm very bearish. I think the market's going to go down a lot. And he said, oh, well, what are you doing? Well, how do you prepare for that? And I said, well, I'm buying stocks. And he's like, well, what? That doesn't make any sense. But I was buying at the wave 1 low in anticipation of wave 2. So this is something unique that Elliott waves do that I think other forecasting techniques don't necessarily do. It's not like you get a bullish or a bearish signal or anything like that. In other words, it's not a linear message. It's a fractal message. So we can have an uptrend within the context of a larger downtrend. So of course, after that wave 2, what comes next? It's wave 3, which is the most powerful move down. And that's what happened. And if you remember, Lehman went bankrupt. Merrill Lynch was sold to Bank of America because I think at the time, investment banks couldn't be bailed out, but banks could. So they did a lot of legal shuffling to make sure the banks survived this. And of course, there's the infamous $800 billion bailout of the banks, which seemed huge at the time, but now if in the repo market, they've already committed half that. So we might have more larger bailouts to come. But at the time, it was definitely huge. And this is when I really got hooked because, it was one thing to see these patterns unfolding on a chart, which was enough for me already, just to be able to have an understanding of where the market's going, especially in an environment where many other people were confused by. But also it was that, these patterns on the chart had a real world implication. I mean, these are major, major events happening, the stability of countries, and it's all coming from this chart pattern. Of course, we have an entire field of study dedicated to why that is the case. It's not really the purpose of my talk, but it's called socionomics, and I invite you to read about it. But basically, it says that the mood of the populace is the primary driver of both the patterns you see on the chart and the real-world events. So in other words, the fear comes first, and then the systemic failures come after the fear. So we had the crash. This was one of the most significant moves, I guess, since '87, in terms of actually affecting the banking system probably since '29. And so we had the wave 3 down, and then we had a bounce. Now, some astute analysts who had actually called the crash at this point said, oh, it's over, and we've had the major move down. Everything is so oversold, but according to the wave model, we needed one more move down, which we got into March. And so once the entire structure is complete, at this point, the message is clear. We're saying, okay, we're going to get a move up that should be commensurate with the move down that we had before. So there's our completed Elliott wave structure. So I ended up having a conversation that went something like this. I love Dilbert. This is, Wally, I need you to head up our artificial intelligence project. We'll have no budget and no hope of success. I just like saying that we're working on AI. And you're completely useless, so it's a good match. I sent this around to the team because sometimes it feels like this because when you're facing a large research project, it can feel like you're spinning your wheels. A lot of work we did when we started working on E-Waves was going down a path for a long time, discovering some new things, saying, oh, that's how it works, going back and then kind of rewriting it. So, it's hard for me to recommend research necessarily. You have to have the right mindset, I think, to do it because it can be frustrating at times when you're going through that, but there are rewards at the end of it. So one quick thing before I jump into my involvement with E-Waves, I took a little diversion. I didn't actually directly go and start working on this. I spent a couple years in Las Vegas working at a hedge fund, and I really enjoyed that experience. I got to learn a lot about quantitative modeling, both building long-term models as well as building very short-term intraday type of models. So it was a very good experience to understand how that world worked, before I went to work on E-Waves to just kind of round out the experience there. So after I joined, what we did in 2014 is we put together the first version. This, again, was taking the version that was collecting dust. For those of you who've done programming before, this was written in Lisp. It was about 250,000 lines of Lisp code with no comments at all, which is very esoteric language and kind of hard for a lot of people to wrap their heads around. So it was quite a difficult project just going through that. But we managed to get everything up and running on modern computers. And like I said, the back tests were very, very slow and running it and generating wave counts. But we really wanted to do R&D because the B here stands for beta. Okay, our whole goal with this is, okay, we have this base system, but we really want to bring it up to the level of a human expert. And that's when we'll be able to take the B off and have a release candidate. So it became pretty apparent that making patches to the old version really wasn't the way to go. I decided we really needed to rewrite it and port it in a way that would allow us to understand the old version very, very well as speed it up so that we'd have something we could really do R&D with. So we created version 2, which was a tech reboot of the original. It ended up being about 2 orders of magnitude faster. So these back tests that took a month, we could now do in about 45 minutes. And a lot of that has to do with hardware improvements, leveraging the hardware properly, as well as other types of improvements under the hood. But most importantly, we had something we could completely understand how it worked and have something we could actually get our hands dirty with. So this brings us to the current version, which is version 3, where we took version 2, which was based on the exact same theoretical foundation as the original, and say, okay, now let's focus on research. Let's figure everything that we can learn about Elliott waves, and let's apply them and rebuild this program. So one thing that I want to say is one reason that this takes so much time is because you don't know what you're building. There are other types of software that can be quite complicated, but they're also well understood. You can go online and they have step-by-step, here's how you build it, you can learn about it. But with Elliott waves, there's nothing like that. So we had to go through again and mostly do research. So these 2 original versions are built on a consensus model. And so what I mean by that is that we went to the various Elliott wave analysts who have a lot of experience and expertise, and they've been counting waves for many years, and wanted to get an idea of, okay, what is important and what is critical with the Elliott wave principle. Things like, 2 doesn't break the low of 1, 3 is never the shortest wave, these really key aspects of the Elliott wave model. And so those we kind of call tier 1. These are things where every single analyst 100% agrees on all around the world. Every Elliott analyst says that this is how the model works. There's also other tiers. There's tier 2 and then tier 3. There are different things we divided it into where there wasn't as much of an agreement. We went into some very esoteric things like wave 4 of a diagonal. How steep is that? Does it have a steep slope? We had one analyst that felt very strongly that was important, but we didn't quite have a way to figure out what the answer was to some of these more esoteric questions about Elliott waves. So with version 3, one of the things we decided we needed to do as we were trying to put together the latest version of the model was to build a database that we could test the program against. Because we decided, we don't want to be making changes and then running it and be like a dog chasing a tail. We wanted to have it automated. We would have a lot of example markets, and we could see, hey, how well does the program analyze all these examples? But quickly that led to the opposite of that, which is building a statistical model of Elliott waves. Because as you develop a database of Elliott waves, you can actually start pulling information from those Elliott waves to help improve your model. So I'll show you kind of how that process works. Now, the vast majority of projects, they have an arrow that only goes one direction, from the database to the model. With eWaves, we had it go both directions, and there's a reason for that. Now, let's say you're trying to build software that identifies pictures of cats. So to build a database of that is pretty easy. You can take pictures of cats, and it's very easy for a person to say, yes, that's a cat. No, that's not a cat. Yes, that's a cat, on and so on. So you have a perfect database. Your database is like an oracle. You can trust it 100%. And that way the arrow only goes to the model because basically you can pull out features from the database and you have something you can tune your model to. There is no database of Elliott waves. Okay? It would be great if there was. I would love it if someone came down from on high and said, here's all the perfect Elliott wave patterns and you can study them. But of course, we did have all the best experts at EWI. So what we did on the database side was very similar to the tier 1 consensus stuff we did. So we said, okay, well, let's figure out what we can start with. So on the model side, we said, okay, wave 2 can't break wave 1, wave 3 can't be the shortest, and so on. And then on the database side, we said, are there any Elliott wave counts that the analysts all completely unanimously agree this is the correct way of labeling them? So those became kind of the tier 1 wave counts. We call those iconic counts. So these are counts that, like I said, they're unambiguous, but also they cannot be real time. That's very important, because if you're trying to count a market in real time, oops, something could, it could violate an Elliott wave rule, and you realize, oh, we were counting that incorrectly. So these have to be historical wave counts, so that nothing that happens in the future can possibly invalidate them. So once we did that, then we could feed that information kind of back into the model. The model got smarter, and then the model was able to help us disambiguate other Elliott wave patterns that maybe were tier 2. And so actually, it's an extension of the consensus model in a way, because we still had the experts to talk to, but the model itself became yet another expert. So I would classify this as a co-evolutionary approach between model and database back and forth to developing the model for version 3. However, there's an important saying here. There's lies, damn lies, and then there's statistics, which is even worse. So I've just talked about building a statistical model of Elliott waves. But there's a problem. If you've applied statistics to financial markets, a lot of people who've done this have gotten themselves into trouble. And I want to explain why that is and why I think our approach is a little bit different. So there's 3 levels of understanding statistics with regard to financial markets. Level 1 and 2 here, I'll get to level 3 in just a moment. So level 1 is the belief in stationarity, and level 2 is where you realize the market is actually a non-stationary process. And I want to explain those 2 terms because they sound big, but they're not actually very complicated terms. I actually have this slide of a population sample of different regions, but thinking about it last night, I actually came up with an even simpler approach. So maybe it'd be better not to look at this slide. If you imagine a big bowl of soup, okay, and you mix up the soup and you have a certain ratio of peas and carrots and potatoes. Then you take a ladle and you pull out some of the soup and you put it in a bowl. Then you take another ladle and you do the same thing, put it in another bowl. Then if you look in each bowl, you have roughly the same ratio of peas, carrots, and potatoes in each bowl, and the same as the soup. Okay, so the soup is stationary statistically with respect to the location that you pull stuff out of it. So in other words, the statistical properties of the soup are invariant to where you pull stuff from the soup. Okay, the market doesn't work like that. The market is a non-stationary process, and one statistician that has worked with Elliott wave in the past has written a lot about that. His name is David Aronson, and I respect his work a lot. And he talks about basically. Let me give you a good example of this. So let's say you're building a model, and you're training this model on 1980 to 2000, and you focus on tech stocks. What do you think the statistical properties of those stocks are going to be during that time? It's basically going to be extremely bullish. It's going to be buy, 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 buy. So you want to make something that is very biased towards the upside. But then, of course, the tech bubble bursts, and the model that would have done well in that environment in a different environment does not do so well. Okay, that's because the market is non-stationary. The properties of one period of the market are different from the properties of another period in the market. The environment changed. And so this was something actually the fund that I worked at was cognizant of this fact. He talked about it a lot. Non-stationarity means burnout. It means eventually the model will hit a period where it's not going to work. And that's just inevitable because the market is non-stationary. So let's move on to the 3rd level of understanding here. But first I want to say there's a trick here. Both of these methods are quantitative, whereas the method we're employing with the EWAVES model, or the latest version at least, is what we're calling qualitative. It's a different approach, and the key insight here is that the market is a fractal, so model it as a fractal. It's really that simple, so let me define qualitative a little bit better for you and what that means. It basically means in the software, when we're examining the statistical properties of the market, we can do so, but we have to do it with respect to very important invariants. The most important invariant for Elliott wave analysis is scale invariance. So, for example, if in the software I were to accidentally write something that was not scale invariant, it would crash and it would complain and say, hey, you're not adhering to your invariance, you're not being what we're calling qualitative about it. So the idea with our model is, we want the program to say whether something it looks like a certain pattern or not. We don't care what time frame it's at or what scale it's at. So that's one of the key things that makes it different from other approaches, is just, again, adhering to those really important invariants. And what's cool about this is if you adhere to these, then you can look at the markets from the 1920s leading up into the 1929 high. You can look at the cotton market, you can look at gold, you can look at futures, you can look at short-term, long-term. It doesn't matter. It all comes out the same, and the model looks the same. So because of that, we believe we've achieved stationarity, which gives us a model that we think is universal. So it should work across all financial markets and not exhibit burnout. Another property that we've been working a lot on is accuracy because of the automatic learning engine. So the program can self-tune based on the Elliott wave examples that we provide. So that database that I told you about earlier is something that's ongoing. We're auditing it often. We're adding more examples. We're constantly doing research on Elliott waves. And as the more examples we add, the smarter the software gets, because it has this memory of many markets and many Elliott waves that it's seen before. It's objective. Of course, it's a machine. It better be objective. But if you listen to Ron's speech, I saw a lot of you nodding your heads during that when he was talking about mindfulness and how difficult it can be to be objective in financial markets. Because financial markets are all about your emotions when it comes down to it. So I want to go to one of my favorite charts and one of the most emotional things we've seen in a long time in finance. Do any of you recognize this chart? Yes, that's correct. It's Bitcoin. So it went from fractions of a penny to $20,000. We haven't seen anything like this in a very long time. But the period I want to focus on is this upper right-hand corner. And the reason I want to focus on that is because when we were putting together a big report on Bitcoin, we went through looking for news articles on it. And this entire move up from fractions of a penny through that first intermediate major high there and the decline, there were hardly any news articles about Bitcoin at all. Nobody was really interested. There were a few at the major peaks and troughs in here, but really not much. It was only in this final move here that suddenly everybody just jumped on board. There was a book boom, tons of books being written about it, Google searches. Paris Hilton weighed in on it. She was tweeting to 16 million followers about her cryptocurrency investments. And what I think is cool about this is it wasn't her Bitcoin investments, it was her cryptocurrency investments, which means she was buying what they call altcoins, which are variations on Bitcoin. I didn't know she knew that much about cryptography. I did talk to her about speaking in IFTA 2020 to follow up on this call, but I think she's busy right now, so we'll wait and see. And then the big boys got on board, the institutions. So universities started launching cryptocurrency departments, Bitcoin futures were launched, the Fed started thinking about its own currency. This is a major news, and these are all happening. Look, November 2017, December 2017, this is right near the top of this chart here so far. In fact, I remember getting jerry-rigged into a debate with a guy that unfortunately is still on YouTube. I think it has maybe just a couple hundred views, luckily, because I wasn't prepared for it. But luckily, I think I was on the right side of this because he was arguing this is extremely bullish. I think that was the consensus, because once the institutions get on board, gosh, that's a lot more kind of power behind this move here. But of course, I thought the exact opposite was the case, because of course, once the big boys get on board, it's usually when a trend has been going on for a while. But most people don't know that. The vast majority of the public were just enamored by this. One of my favorite things that I read was a man who had sold his house He sold all his belongings. He and his family were living outside in the woods cooking hot dogs, and they interviewed them. And he said, yeah, we're just can't wait to get rich on Bitcoin. And they put all of it into Bitcoin in December 2017. And then there was the FOMO, fear of missing out. The worst quote there is, everyone is getting hilariously rich, and you're not. And just to, like, you know, put the arrow in you right there. But I think the craziest aspect of this move, and my favorite by far, is Dogecoin. It really just epitomizes the whole thing, which was that one person who, as a joke, copied Bitcoin, made a clone of it, made a few minor changes, and put a funny-looking dog face on it, and they bid it up to over $1 billion. So, very interesting. All right, so what I'm warming this up into is that the vast majority of people were extremely, extremely bullish on this, and it's easy to get swept up in this. I think in this room, there's probably a lot more contrarians that know when the headlines are saying this, you got to be careful, but most people don't know that. They get swept up emotionally in this market. And of course, what I want to show you now is what EWAVES thinks of this particular event and what makes EWAVES different. It doesn't know about this. It doesn't know about the blockchain and all this amazing technology and all the hype. It doesn't know what Paris Hilton is saying. All it knows is open, high, low, close for this day. Open, high, low, close for this day. That's it. We just throw the data in and then tell it to count the Elliott waves. So this is the wave count for this one. On the upper right hand, you can see 5 of 5 of 5 of 5. So what it's saying is, all right, the mania is over. You know, we expect a major decline. Now, one thing that I will say is, hey, Elliott, you're running this in retrospect, right? Yeah, that's true. Although I will say at the time at Elliott Wave International, we did make the same call. But the software doesn't know that it's running in retrospect. I mean, the data is clipped to just this region. As far as it knows, this is happening in real time. It doesn't actually know the difference. In other words, it doesn't cheat. It doesn't know the market's going to go down. And then one other thing, that just so I don't get questions about it, as far as affecting the model, to have this as one of our examples, it's less than a fraction of 1%. So in other words, this isn't going to have an undue, the program's counting Elliott waves, in other words, and this happens to be a nice Elliott wave. It's not fit to this example because it's such a tiny, tiny fraction of all the Elliott waves we've studied. And so, of course, this is what happened afterwards. If you were unfortunate enough to hold Dash, it went down 97%. Oh, Bitcoin Cash down 98%. So, these, again, just like the 2008 era, these little squiggles on a chart have very big real-world implications behind them. So that's objectivity. So I want to talk about how we made the program real-time, which actually relates to objectivity. Because, one thing that's hard when you're a person and you're trying to be objective with your analysis is when you're wrong. How do you deal with that? Now, it can be difficult, especially if you go to a news agency and give them an opinion, and then 2 days later, wait, I changed my mind. It's too late, you can't do that. But the program can do it, and it doesn't care. It doesn't care when it's wrong. So what we did is we built in something called adaptive recognition. So it recognizes the most probable future path for the market, but that might not be what happens. Sometimes something less probable happens, and then you have to change your mind and do so as quickly as possible. So I want to take the Bitcoin data, because again, I like this market. I'm just going to clip the data down. So again, the program doesn't know anything about anything really except for that little segment of data right there, and we can run it. And so it's saying, all right, the best way to label this is 1, 2, 1, 2, 1, which means, all right, we're going to have a third wave, which is what happened. The market kind of continues higher in a third wave. And then we peak in wave 3 and then finish at wave 4. And again, another aside about this, for those of you who are astute wave analysts, you might say, well, 3 is rather low slope. It's kind of a little bit weak in terms of its price movement. That's completely true. But that's only one part of the elephant, and the program's looking at, of course, many other factors to say that it believes that is the top way of labeling it. And same here with the wave 4. A little small for wave 4, but if you were to relabel that, you have some issues around channeling. You also have issues around wave A breaking wave 1 or potentially breaking it. So again, it's weighing all of these different factors. So then we got 1, 2, we're finishing up wave 5, and then here the program says, it's done. Bitcoin's going to collapse. Of course, you can see there's still some room there. But what's interesting about this call is I made this exact same call. The disadvantage for me is that CNBC called us and we went and talked to them and it was very public. And then the market popped up to a new high and we went, oh no, didn't think that would happen. But what makes me feel a lot better about my call is going back and studying this and seeing why the program does it. And could I fix it? Is there a way I could jerry-rig it and say, you know what, it was wrong here. There's got to be some reason the market really should continue higher. I got to force it to count this as not all of wave 5, but one of 5, and expect more bull market. Unfortunately, the answer is no. If there was some magic extra thing that I could discover about Elliott waves that could help, that would be wonderful. But as far as we know, probabilistically, this is the most probable thing that would occur at this point. We don't expect extended fifths. Extended fifths don't happen very often. So going into it, you shouldn't go ahead and expect one to occur. It's just unlikely. So now going back and having done several years of R&D on Elliott waves, I can go back to the call that I made before and feel good about it and say, okay, I actually did the right thing. Because again, if I were to jerry-rig it and have it expect an extended fifth wave, then all of those other markets, it would be expecting more bull market when actually they were ready to turn down. So net, it would be worse. So we always have to choose what we think is most likely at all times in order to be correct the most often. And you have to accept whipsaws like this. But the good news about the program is it doesn't care. It's not going to get married to it. This is very hard to do as a human analyst, though. Once you make a call, it can be very hard. In fact, I was talking to a gentleman earlier about this who said this is one of the problems with being an analyst. Traders, the market goes up, okay, well, I'll just hit my stop and now I'm going to go the other direction. But if you're an analyst, it's more difficult to do that. For some reason, people don't expect you to ever do that kind of thing. So we'll just kind of continue to extrapolate the wave here all the way into the end. I think there's 3, expecting 4. And I want to show what happened here at the very end, because I think this is kind of interesting. At this point, it's basically given up. It said, okay, we're in an extended fifth. We're going higher. But it doesn't expect the fifth wave itself to have an extended fifth, because again, that's not very likely. So it's saying, all right, 5 is going higher, but at least we're going to have a nice looking 5, 1, 2, large third wave, then expecting a 4, 5. Now we didn't get the 4, 5. Instead, we had a triple extended fifth, which is pretty rare. It shouldn't expect that right off the bat. That's why it was putting these labels on before. But we got it, and at this point, it did see it and gives the second call for top. This one was the top. So the reason I wanted to walk you through and kind of get an idea of how it thinks and how it's applying wave analysis to this example, just to give you an idea of how it works. So that's real-time adaptive recognition. It's detailed, and I'll give you a quick example of that. And this is the one that comes from running on a modern computer, which is just incredibly powerful. And we can do analysis in just a couple seconds that for a human being would take a very long time. If you're doing wave analysis, it's important not just to do a cursory overview, but to dig into each wave, because the internals support the larger structure and give you a higher chance of being correct. So if we run it on this, we can apply maybe 6, 7 degrees of depth. So quite a lot of detail that we can put into supporting the wave analysis. This is 1932 to 37, going down into towards where World War II started. But one thing I want to show you is that this picture, even with all of this detail, is only a tiny, tiny little blip when you look at the Dow going all the way back to 1680. In the version we're working on now, we're starting internal testing soon, and we have the program starting in 1680 and counting the Dow all through this data from 300 years ago all the way down to the daily data. Ultimately, we want to do intraday. We don't have that planned yet. That'll be the next version, but it's going to be, as you can imagine, quite a lot of detail going into this analysis, and certainly an amount of context that would be difficult for one person to manage efficiently. So that's the detail aspect of it. It's perceptive. Now, Sometimes Elliott waves are not always as clear as you would like them to be, but there's a couple ways we mitigate that. So by perceptive, I'm talking about it being able to see kind of weird Elliott wave, weird patterns. So if you take a quick look at this, you might squint at it. Most people would say, okay, if I look at it from a distance, this is an obvious three-wave move. It's a corrective move. But if we run the program on it, we'll see that it actually sees it as an impulse wave, which is not quite readily apparent when you're just looking at it cursory as a person. But this is a very bad impulse wave. It's very weird. We have wave 3 being very short. We have wave 5 being very short. We have an extended first wave within wave 1. We have leading and ending diagonals. We have a lot of weird stuff going on. So how are we able to tell what this is, even though it's very unusual? Well, it's really pretty simple. It's because every Elliott wave is not just a tree, it is a forest, because it's a fractal. So you can look at the subdivisions, and a lot of these divisions, like puzzle pieces, fit together. And if you study each subdivision, they're actually pretty good. Like the diagonals in there are very, very nice diagonals. Double 3 is very well formed. There's a lot of aspects of this that are good. So when it puts them together, it says, all right, well, even though that impulse wave is not very good, the subdivisions that support it are so good and clear that we can say, all right, this bizarre looking pattern is actually pretty likely. So that's one way we can deal with kind of strange looking Elliott waves is bottom up. You can look at the subdivisions and that can tell you what the larger picture is doing. But there's another type of problem that you come into with wave analysis, which is that sometimes the larger picture is not the smaller picture is not particularly clear. So you can't really rely on this bottom-up puzzle piece approach. So to deal with that, we made the program very, very strict, just really uncompromising with respect to Elliott wave principle, which was kind of actually controversial at the time because a lot of people felt Elliott waves needed to have lots of leeway within them. But actually we found that through the research that we've done, that we found a lot of ways we can improve the strictness of the Elliott wave principle. So this is back to the Bitcoin chart that I showed earlier, and you can focus in on this area here. It's very hard to put any kind of labels on that, especially in that context. You might think it's a triangle or something. It's kind of sideways. There's a lot of overlap. But it doesn't really fit any of the patterns very well. And sometimes this happens. Financial markets, to the extent that they reflect Elliott waves, are to the extent that people are buying and selling based on their mood. And there are all kinds of other factors that can affect things, such as the liquidity on a particular exchange. Bitcoin has lots of exchanges. I don't know which particular exchange this is, but you can imagine all kinds of reasons why that would be the case. But in this case, the nice thing is we don't have to know exactly what that move is because we can tell by the surrounding context. We can just say, okay, we don't know what that is, but look, now we know it's within a third of a third of a third, so it must be a motive wave of some type. So the surrounding context can help you disambiguate the smaller picture. There are also other techniques you can do, sort of fallback if you can't do full-blown wave analysis, which is the ideal. But one of those approaches that we've been able to steal from mathematicians, which is one of the few that they've given us to deal with fractals, because there's not much written about analyzing fractals, is the fractal dimension. And that was useful too. And what that basically says is, does it look like a line or does it look like kind of a squiggle? And give us kind of a way of differentiating between those types of moves, which can give you a very rough idea of it being motive or corrective. It helps, but of course, you need real wave analysis. This is a move that is actually randomly generated data that I ran through the software just to see what labels it would put on it. It couldn't, so it just says this is not an Elliott wave. Now this is important for two different reasons. The first reason that this is important is because we want to do academic studies on Elliott waves in the future. And one of those studies is called real versus random. We want the program to be able to tell the difference between real data and random data. And now say you built a system using moving averages instead of Elliott waves. Those might not be able to tell the difference between what the underlying data is. Of course, you probably don't really care. It's not that important. But for us, it is important because we want the software to be able to tell that difference. Because a lot of people in academia claim that you can't tell the difference. And we think they're definitely wrong. That's one of the first academic studies we want to do, is be able to show the difference and say, look, our software can identify the difference between real financial activity and made-up financial activity. So it says it's not an Elliott wave. There's a second reason why it's important for it to do this. This is actually an actual stock, and it says the same thing here. Because again, like I said, sometimes the market's not always clear, but it's much better if something isn't clear to just step back and say, you know, I'm just going to relax and I'm not worry about this. There's hundreds of other markets I can look at that might be clear. So why waste my time? So if it's not a high probability of even being an Elliott wave, it's best just to not do anything. So that's all part of the program being very, very strict. Here's the last one. This is just some squiggles that we drew by hand. So what do you think this is going to be? Well, this is a trick one because I've shown you two that weren't Elliott waves. This is an idealized Elliott wave. So it's a perfect Elliott wave. These types of Elliott wave patterns we use on our CEWA exam that we talked about, that we're partnering with IFTA on. And the CEWA exam has hand-drawn Elliott waves. A lot of them are very, very nice. And most people, when they learn the Elliott wave principle, they take the CEWA test at the end of it, and they're basically trained on example models like this. And then they go and they look at the real world, and they trade real Elliott waves. We did the exact opposite with this version of E-waves, because I was very adamant from the very beginning when we started our database that I didn't want to use any example models that were hand-drawn. I wanted every Elliott wave to be a real Elliott wave from a real financial market to see what we could learn from it, you know, be very pure in terms of doing research. But what was cool is then after training it on real data, we went back and ran it on these idealized hand-drawn examples. And these are very easy for the program to do, as they should be. But you know, once you've done the School of Hard Knocks, for those of you who've dealt with real-world markets, you know they're much more difficult to deal with. So that's all about the program being very, very strict, and why I think that's an important property to have. So kind of in summary, we have a qualitative model. So we believe we have stationarity because it's scale invariant. So it should not burn out, has built-in learning engine, objective, changes its mind with lots of detail and ways of dealing with, you know, the fact that the market is quite messy sometimes. So here's what the interface looks like. We're just starting internal testing soon, so we're actually putting this together right now as we speak. And you know, I think the future is our web apps. A lot of you probably are getting used to that using Gmail, Google Sheets, you know, as opposed to having a locally installed software. So what we decided to do with E-waves is run it all on high-end servers, and then have a web app as a portal into that. So people will be able to log in, look at their markets, and then again zoom in and zoom out. And like I said, zoom all the way out to, you know, 1680 to get that very long-term view, or zoom all the way in. And initially these will be end of day, but eventually we'll have real-time intraday updates of that wave count. So I'd like to end here with just some of the challenges that we hit when we were building this next version. So one of those is just the scope of the project. It's a very large project, especially going through the original version. One thing that's interesting, though, is that we actually got smaller as we went along and worked on it. As we understood more principles about Elliott waves, we realized we didn't need a lot of special cases because there was actually a little more elegant theory that could express them much more cleanly and simply. And as we started discovering a lot of those, it actually shrunk. The latest version is actually about 1/3 the size of the original. So a lot easier to deal with, actually. But again, that's because of all the research we've been doing. We have to put together a lot of tests. If you actually saw me working on it, it would be very, very boring. Because as we're building it, we hit a button, we run a huge amount of automated tests. But these are very, very important because, again, we don't want to be chasing our own tail. We want the market to We want the program to be able to look at lots of historical markets and make sure it's analyzing all of them very well. Again, the research was a big part of this. We wanted to answer, what are Elliott waves, and answer it really, really well. And of course, we know what Elliott waves are, or a lot of people here do. But I guess what I really should have said is, what are Elliott waves formally? Can we answer questions in a really succinct way, like how do you determine the degree of a wave? And many other questions like that. So you might think, well, determining the degree of a wave is easy. It's the size, right? Big waves are big, they're big degrees, and small waves are small degrees. That's not actually true. If you go and study a lot of history, you'll quickly realize that's not the case. A perfect example of this is if you're in a rising trend, and you have a third wave at multiple degrees of scale, say a 3 of a 3 of a 3, this is when the market, it really accelerates, and it can be maybe 5, 6 degrees smaller than another wave, but many times larger. So you can get waves that are actually several orders of magnitude larger, but many degrees lower, and that is actually very common, happens all over the place. So that was something we had to deal with, is answering questions like these and figuring out how do you address this in a formal way. It's one thing to learn a lot about Elliott waves and do a lot of research. I think that part we've done really well on. But the second part of that is actually building a model based on Elliott waves and being able to actually count the market in real time like I showed you. So that's kind of the next step up after you do the research, is how do you apply that research? So that was one of the problems we hit. Elliott waves is a really nice model, especially when you see the abstract examples. But the real world is incredibly messy. So how do you translate between that and an abstract model? That was one of the problems we had. One of the most difficult markets to count, I think, are futures data. In my last job, we dealt with futures, but we would generally back adjust them. But the problem that we looked at is across the industry, the back adjustments, none of them work with Elliott waves because the prices go negative. And that's not going to work if you're going to do any historical work. So we had to come up with ways of mitigating that and figure out new ways of back adjusting data. The last part of this was keeping the program real time. So like Robert mentioned yesterday, we didn't want to take any shortcuts. We want to make sure that the way the program works is in accordance with the Elliott wave principle, and that's paramount. Shortcuts might be like taking a move that's already occurred and trying to force subdivisions into it for an impulse wave or a zigzag. And that's not how we approach it at all. We count everything in real time, which of course means dealing with partial Elliott waves. So we're not dealing with completed structures. And that's a different type of a challenge. And in order to do a good job at that, we had to give the program imagination. And so the ability to imagine, not just see the wave labels as they should be on a chart of data, but to imagine the implications of those labels and what's going to happen in the future. In other words, to extrapolate the picture and say, okay, we're in the middle of a flat, which means we should go down, then we'll go up, and then we'll go down again here, and give you an idea of what the future should look like, and of course, continually updating that model of the future as we move forward. So I think that's the conclusion of my talk. For now, we have a few minutes if anyone has any questions. But before we do that, I'd like to thank Tamer, I'd like to thank Mohammed for putting this on. I really appreciate everything that you've done, and especially to Ron William, because without him, we wouldn't even be here to talk. He's come to Georgia to our socioeconomics conferences, so I'm very happy to come to Egypt, where he is from. So.
Thank you so much, Elliott. So as Elliott said, we do have a couple more minutes. If anybody has...
I'm Oliver from Geneva. I have a question concerning the very long-term chart from 1680. And
yes.
Related to the way the model is counting the waves, does the starting point is important and change the counts?
Yes. Yes, the origin is very important, and we've dealt with issues with that because we don't actually know exactly in 1680 where the data starts. In fact, only part of that is the US Dow, and if you go back, it's actually the London exchange, and we had to put the two data together and make them stitch together. But yes, that's true. But what we can do sometimes is reverse extrapolate the data and say, okay, sometimes if we're not quite sure where it started from, but you know you have a 2 and a 3, you can say, all right, well, let's kind of pretend one started right about here, because you know the large-scale structure, it shouldn't have too big of an impact on it exactly where you put the wave 1 low, and we can always change it and update it. So.
Okay, we have another question.
Hi, thank you very much. I just have a quick question about the time frame.
Okay.
You saying that you're going for a intraday level?
Yes.
And you can look at deep time frames. At what point do the time frames get almost the noise doesn't give the signal of a negative wave, it starts to sort of just cloud over and become.
Oh, I see what you mean.
So where do you get
Yes.
really clear waves, and when does it almost become a blur?
Yes, that's actually a very good question, because it's something that I'm researching more. Because I talked about times in the market where you can't actually tell what the Elliott wave pattern is, and so you do have to gloss over occasionally and rely on the superstructure to clue you in as to what that move was. That can happen at different degrees of scale. So the way we built it is to just say, look, if you can get the detail, go for it. If you can't, then you can't. So I think it depends a lot on the market, and there are some markets where you can just keep zooming and keep zooming, keep zooming, and it just keeps going, and in very nice structures at incredibly small time frames. But generally speaking, I would say the bigger pictures are clearer, and as you get lower, you're right, you tend to get more noise, especially once you get down to intraday and you have people going on their lunch break and the Fed has an announcement or whatever. There are little intraday gaps and things that can happen that can be not directly tied to social mood and Elliott waves.
Okay, sorry, the last thing was, you said it had some limitations in the futures market.
Oh, limitations?
Well, not limitations,
oh.
It's clear.
Yeah, well, I mean, if you're trying to count an Elliott wave and the prices are going negative, it can be a little bit difficult. We do everything in log scale, and you can't even take the log of a negative number. So we tried a bunch of different approaches. Instead of the standard back test, you can do ratios, but we found that those actually corrupted the way the picture looked. Because, with futures, there's a premium or a discount, and over time that kind of decays until it converges with the spot price. And so to do it right, you really would have to model that process and get it back at what the real prices were. But what we ended up doing was just saying, forget it, this is too hard to deal with. So instead what we do is we load 2 sets of data. We have the cash spot price, which is the data we'd really like to analyze. But unfortunately, it doesn't trade very often, and sometimes you can only get closing prices, or you can only get weekly sometimes. But the good news is you can use the futures data, combine it with that data, and kind of fill in the missing pieces without getting the gaps that you get in futures.
Thank you very much.
Okay, thank you, Elliott, so much. That was very insightful.